Okay, well, I'm not sure where my team is. That's okay. We're going to go ahead and get started. Welcome, everybody online. We really appreciate you being here. How about the holidays? Was it good to everybody? Really good? How good? Glad it's over? Catch me after the... I'll tell you a real quick story about Christmas to me. For those of you who know me already, I was with the most loved company in the world for over 35 years. Does anybody know what that is? See, everybody knows the most loved company in the world, right? Hallmark cards. 35 years. But one of my jobs was getting ready for Christmas. Guess when I had to start Christmas every year? Right after Valentine's Day. As soon as Valentine's Day was over, you start Christmas. Because how many of you have been ornament shopping? It's in the stores on July 1st, isn't it? You go buy your Christmas ornaments. So I would never tell this to my kids. I got to get home and erase this before I get home, so they may be watching me. But by the time it got here, it was just, can it get here? Can it get it? And guess what? When it was over, 6 weeks later, you start over again on the next Christmas. But anyway, I love the holidays, Bronson. I'm not glad they're over. They were great. But I'm glad that everybody had good, prosperous, hopefully had a Merry Christmas, great New Year. Hope you didn't party too much, but if you did, I didn't get an invitation, so I'm not sure what that's about. But anyway, thank you for coming. I was going to introduce my team, so I'm going to start with the people that are in the room, and then as other people walk in, then I guess I'll introduce them too. As I said, before I start, I would like to see a show of hands, all those, this is your first time here at a DGRE meeting. Anybody? Okay, we got a few. All right. Okay. I would ask that you please do not leave tonight without giving us a chance to meet you, please, okay? Meet me, meet Julian, meet Reggie. I'll introduce these people as we go. So without any further ado, I'll start introducing John. Would you stand up, please? John Blackman. If you've been here before, you know John Blackman He's kind of our market maker / going to be co-sponsor down in the Austin, Central Texas area. We haven't quite found a property yet, but we're still looking, right, John? So John came up this morning from Austin, Texas, sat through our staff meeting all day, just anxious to soak it all up, and we're anxious to find a property for him. Reggie, stay up. Reggie Betos. For those of you who don't know, Reggie has been a co-sponsor and has already been through the process of acquiring a property, operating that property for a couple of years, and selling the property. Tell them, Reggie, you just tell us a little bit about your experience, if you don't mind. So it must have been a pleasant experience.
Everyone here was helpful.
There you go.
One thing I do want to say, and I always forget to say when I get up there because I get nervous, is that DGRE, they go up there, they smile, they make everything look so easy. But I've seen behind the scenes, I've been able to look behind the curtains, and there's a lot of kicking and scratching going on. There's a lot of tough conversations they've had with me, which all has helped me. Contractors, they're consistently trying to get lower prices for repairs, and they do a lot of work, is what I'm saying. A lot of work is done behind the scenes, and they don't get enough credit, I think. They make it look too easy.
Thank you, Reggie. And I should say, for those of you that are new, when I say co-sponsor, it may not mean anything. We have a program where somebody wants to learn the business. They don't really feel like they know enough to go do it on their own, so they come in. We take them under our wing. We help them find a property. They're a co-sponsor in that property, and then they operate it for 2 or 3 years. I mean, we're typically usually the management company, leading them and helping them through all the way through sale. So they're basically learning the business from us. So thank you, Reggie. Where's Ben? Oh, there he is here for us. Stand up, Ben. Ben Mandelstein was also a co-sponsor and has already acquired a property, operated a property, sold a property, and is already on his second property. And so congratulations, Ben. And I should have asked Reggie this, but give us an idea of what was the total ROI of the property that you acquired and sold?
Yeah, should end up being about 73% when the final check goes out. It was and that was in 18 months, so just a year and a half.
Congratulations, Ben. For those of you, Julian Alexander, again, this is one of them I would ask you too. If you're new and this is your first meeting with us, please introduce yourself to Julian, myself, the rest of the group. Talk to Ben, talk to Reggie, talk to any of the group. But Julian is kind of again, we wear a lot of hats around here. Nobody has one title, and we don't really care about titles, to be honest with you. So Julian helps underwrite. Julian's also head of our investor relations committee. So if you say, I want to invest in a property, he's the one that's leading you through the process along with his partner Garrett Stroud, and getting everybody signed up and NIMS. And if you've been through that process, you know what it's like. They make it easy, right, Cheryl? Right, Monty? Okay, what I'm going to show you is, as seen on Fox Business News. If you have not seen this on Fox Business News, then you get to see it tonight. But this is running on Fox Business News channel.
Most Americans think the only way to become a millionaire is to invest in the stock market, but that's simply untrue. There is a way to build passive wealth through real estate without the headaches of tenants and toilets. The Darwin German Real Estate Investment Team can show you how. By investing in projects like this, you're buying into the cash flow and insulating yourself from the volatility of the stock market. After acquisition, buildings like this are revitalized and rented to those who need quality housing at a fair price. Updated and rehabbed apartment buildings become a win for investors, a win for residents, and a win for the community. Darwin German's long track record of success has created countless millionaires through long-term wealth building in real estate. Come join the team of over 800 investors and counting. To learn more about investment opportunities, visit darwingerman.com today.
But that was very cool on Fox Business News. It's also running on PBS nationwide. So that's a fun little thing we're doing there, and hopefully we get something out of it. Odds are we won't, but that's okay. Agenda, real quick, we're going to go through and make some introductions to Ben and Charles, talk about our investment strategy, what happened in 22 and what's happening in 2023. Okay? This was a great graphic of 2023, as 2022, of all of the chaos in the market. Who's experienced chaos the last year? Okay. Those who didn't raise your hand, what's your secret? We'll see. Well, I want to go ahead and do some introductions real quick. Ben, come on up. This is Ben Garland. Ben Garland, he played with the NFL and all of this good stuff. So I'll let him tell little stories, and we're proud. We're bringing on, we've got some exciting things. I don't want to steal any of his thunder. I'll let you go ahead and talk.
Hey guys, all right, speakers. Is it working? There we go. All right, my name is Ben Garland, like the slide shows. Graduated from the Air Force Academy, went on to play. Wait. Air Force Academy. Went on to play 11 years in the NFL. I did my first 5 years for the Broncos, the next 4 for the Atlanta Falcons, and then my last 2 with the San Francisco 49ers. Had an enjoyable career. Simultaneously, I served as a major in the Air Force. I'm currently stationed at Buckley, the Air National Guard in that aspect. So I was really blessed to be able to do both and be extremely proud of 2 incredible uniforms I got to wear, both either in the NFL or in the Air Force. And obviously the Air Force one was a little bit cooler. But after retiring at the age of 33, gives you a lot of time to think about what you want to do. And so it really made me think, like, what do you want to do with the rest of your life? I mean, I'm still serving in the National Guard, but that's only a part-time gig. So I kind of thought of, like, what is success? And success to me is relationships, whether that's with your family, your friends, or the people you work with. And it gave me a lot of opportunities. I mean, I'm in a place where financially I'm relatively set, so I got to choose. And you get to make that decision of who do you want to work with. And so I wanted to look. And I was always interested in real estate, and so that was an aspect that I thought I want to look into. But then where do you go with real estate? Who do you invest in? Who do you trust? I got way too many fingers going the wrong direction to earn this money that I have to invest with the wrong person. And so I had to look and, like, who do I really want to invest in? Who do I want to trust my money with? And you get everywhere from the Grant Cardones selling those big syndicates to those smaller town people. Especially in the NFL, you're getting 1 million investments. I mean, obviously, if you guys are here, you've got money to spend, and you've got probably everybody coming at you of, like, bring me your money, let's do something with it. So who do you trust, and why do you trust them? And so I was really happy whenever I got introduced to Darwin. And I obviously was excited about the concept when I saw kind of how he's done over the past 30 years, but that's not what's going to sell me on somebody. It's the other aspects that really sold me on Darwin. First, he's going to protect the capital. And like I said, I've worked way too hard to earn my money to lose it. So first and foremost, what's important to me is finding someone who's truly going to mitigate all the risks to ensure that I don't lose the capital that I already earned. And I found that Darwin definitely has that philosophy, and I agree with a lot of things he does to underwrite, to truly protect the capital that he does with the investors. Second is he's transparent and honest. Like, if I'm giving you my money, I don't want a salesman of a car dealership that puts paint on it and is like, no, it's fine, and it gets out the door and it breaks down. I want somebody who's honest with me, open. And he told me, I asked him the hard questions, like, you ever lost on an investment? He said, yes. This is what happened. This is a scenario. This is what I did to mitigate it, to stop it. And some of the people that invest with me now work with me and are some of my closest partners. And so him being open, honest, and transparent with me meant a lot to me. And then thirdly, I think it's his experience. I think it said on one of the first slides in a lot of these banners, our experience is your opportunity. I truly believe that. I mean, if you've basically bought real estate over the past 10 years, you look like a genius. Nothing but up. It doesn't matter what you bought. You probably absolutely crushed it. But I want to invest with somebody who's been through the tough times, who's been through the 2001 crash, who's been through the housing bubble crash and did well. And one of those things where they underwrit and found properties that was going to help the investors. And so finding those three aspects is what really sold me on Darwin. So I'm excited to be a partial owner in the Mercer Park complex. I'm excited to be a co-sponsor and coming up on some of these other ones that are coming up. Super excited about the mark that he's going to tell you about coming up as well. But my big thing is, given this next opportunity, my next career, I wanted to find a way to make money as I give back to community. And what better way to do that than through real estate, as you develop these communities to give back to people and give them a home where they can live. And so I'm excited to bring on other athletes, bring on other investors, and really bring people to something I truly believe in and want to invest in myself. So I'm super excited to be able to be here and continue investing alongside you guys, and hopefully many more that we bring on together.
Do you want to share anything about any of the potential opportunities?
A lot of opportunities we're excited about. I mean, we're working we've got a lot of athletes that are extremely interested in being a part of these, adding their name, their co-sponsor, and bringing in their friends and their assets. And I couldn't be more proud to bring them something. And especially the NFL is a rare fraternity that not a lot of people get to experience. I mean, what you go through to get to that point is so incredibly hard that you form a bond with a lot of these guys. And I think there's something inherent to all humans where you not only want to succeed yourself, but you want to bring along other people with you. And that's my thing, is I want to bring along some of these other athletes. We joke around in the NFL that the NFL for players stands for not for long, because the average career is about 2.5 years. And then after you're done, the NFL stands for no funds left, because so many players go bankrupt. I mean, you are a young kid who learns a lifestyle and has so much money going into things without the financial education. And the NFL tries its best, but it's really hard to educate somebody, as you also need them to master a playbook because the playoffs are coming or the next game's coming. And if you don't absolutely focus on this, you're cut and the next All-American is going to take your job. And so really being able to showcase that, we want to develop an entire teaching series where we give this information of how do you protect your assets? How do you diversify your portfolio? What are the advantages, especially in the tax area, that real estate offers that no other asset class can currently offer because of the way we've built our tax laws? Like, unbelievable advantages. Like, you have to have some aspect of real estate within your portfolio to have a intelligent portfolio, in my mind. But so many people don't know that, don't understand it. And I didn't understand certain aspects either, but I've been really excited to not only learn under them, but continue to grow my knowledge going forward.
A couple of interesting things that you said. First off, what was your nickname?
I had a bunch of nicknames, but Dr. Garland was definitely one I got over and over. I got everything from jet fuel, because I was the Air Force guy that had a motor that just wouldn't stop, to coaches used to have me edit the playbook before they gave it to the other players, because I'd find 30 or 40 errors before it went out. And so one of those guys. I remember having games when we were playing for the Broncos. They came up to me on the plane. I remember the tight ends coach didn't even know who I was. He was like, "Hey, you're that Air Force kid, right?" I was like, "Yes, sir." And he goes, "Can you memorize the tight end playbook by tomorrow?" I was like, "Yes." So played tight end in that game, and they just had a couple guys get sick on the plane right there. So
wow,
it was nice to be able to entrust it with that. But at the same time, it's full panic. Am I going through my bread that whole trying to figure out how to play tight end for the first time? And jeez.
I like that he was recruited by other colleges, including OU, and chose the Air Force Academy. Why was that?
Yeah, I definitely picked the Air Force Academy because I believe that was the one place that could drive me to my true potential. I think in all things in life, if you choose the more difficult path, you'll grow the most as a person. And I had full rides to OU, UCLA, and a couple other big name schools, but what they put you through there is not going to mold me into the man that I wanted to be, and it wasn't going to put me next to the men that I wanted to become like. I mean, show me your friends, and I'm going to show you who you're going to be. And I was like, it's not the same going to a party school as going to one of the academies where I can be next to some of the best and the brightest.
Yeah. I also thought you'd be bigger.
I think the 290 looks good on me right now.
Well, we appreciate having you involved, and looking forward to it. Let's go and give that to Charlie. Now we'll go ahead and bring out Charlie. You met him previously, but he's got a story to tell on what his future actions are and what he's doing now.
Oh, it's great to be here, guys. Thanks for having me back. I did come about 2 months ago and talked a lot about debit and credit accounting and about tax planning. And I think 5 or 6 of you have been my clients for the last 2 months. And we've got some tremendous success stories on the work that we've done. I think we've recovered a tremendous amount of money that people were unnecessarily paying in the form of primarily federal income taxes here in Texas. But I did have a few out-of-state clients. And what I know as a practicing CPA over 30 years is there's 2 things that make a big difference in terms of how fast and how much wealth you accumulate. It's how much you pay in state and federal income taxes and how well your investments performed. And as a career CPA, simply counting others people's wealth over a 30-year span, I observed that my most successful clients, the clients that grew their net worth the fastest, were able to successfully and responsibly reallocate capital out of the financial markets, primarily into real estate and maybe some other alternative assets. And so 8 years ago, after having been a CPA for about 25 years, I took a step back, gave away 30% of my CPA firm, and used the time that I freed up during the course of the day, number one, stop ever preparing a tax return again in my life, but to really focus on ways that I could help clients focus on those 2 key areas in their financial life. And I built an asset-backed lending platform that many clients have participated in that was very successful in the alternative space, but always felt that my clients needed access to world-class real estate investment. I spent the last couple of years here in Dallas helping a private equity firm grow their client base. And what I was able to bring to them was the ability to help clients successfully have a tax plan and a wealth management plan that allowed you to deploy capital into these investment strategies that boosted the rate of return you're going to earn compared to the financial markets, but overall gave you a tax strategy not only around the real estate, but comprehensively across your financial life. And those 2 factors make the big difference. And I'm here today because I've spent a career counting people's wealth. I've done a lot of work in private equity. I've seen every success story in real estate, every failure. And Darwin's been a client of mine for about 4 or 5 months. And what I have found is the business model that he has created over his 30-year career is one of the best in the industry. And the strength of his business model, the consistency, and I'm in the twilight of my career, and I want to align myself with someone that can really add value to my clients and someone as well where I can add value to their clients. So I'm here as part of the team to really bring the integration of world-class tax planning services to the outstanding real estate investment opportunities that you have here with Darwin. So I'm going to be part of the team. I'm going to be part of the growth structure. I'm going to be part of the things that we bring and sponsor to you that we make available. So I'm grateful to be here. I look forward to being part of the community. I look forward to helping every one of you with the things that I've spent a career of work doing that has made a big difference in people's financial lives.
Besides being incredible at your career, you're also the top 10 in the world in what?
Well, I'm a tennis player. I mean, the big thing that I made a change 8 years ago was to free up my schedule so that I could help people on the wealth landscape, but I also wanted to do 2 things. from a work-life balance, I wanted to go fly fishing a lot more, and I wanted to play a lot more tennis. And I'd taken like a 20-year absence from the tennis court, so got back onto the tennis court. I still play 4 or 5 times a week. I compete on a national basis, and I've been able to break into the top 10 nationally in my age group. And I'm close to getting to the top of the game. And one of my ultimate goals in life, if you look back 20 years, what would be the most amazing thing that you could ever do? I said, I want to win Wimbledon. Well, at 62 years old, my absolute biggest goal in life is to win what we call a gold ball. A gold ball is a gold tennis ball that the USTA gives you if you win a national tournament. And I am on the path to try and win that national gold ball tournament.
I can't wait until you win that, because the jokes that are involved with that will be a lot of fun.
Sure.
Sorry. But yeah, so here's the thing. With Ben and with Charlie and with the entire team and everything we're doing, this is why I think 2023 is looking so exciting. And so love to have you on the team. He's going to be officing. We're expanding our offices for investor relations, and Charlie over here in the same building in the lobby. So we'll be expanding into that space, because we're also planning on growing on the acquisitions, property management. So we'll need more team here anyway. So he's here to go ahead and help everybody however they can. Obviously, part of his goal is to free up time, so he's not chained to a desk. But that was part of the agreement here is, hey, you know what? You go do what you need to do. He's also on a couple of radio stations.
Yeah, so one of the things that I got invited to do about 2 years ago was to be part of the Salem Broadcasting Network. And Salem Broadcasting manages all of the major Christian conservative talk show hosts. And I got invited to be a sponsor on the Hugh Hewitt Show. So many of you may have heard me very early in the morning across the country on the Hugh Hewitt Show. Then Mike Gallagher picked me up, and then Trish Reagan, who is former Fox Business, put me on her show. So occasionally you'll hear me in the morning talking about current events, current market conditions, and where I see the economy going and where I see the opportunities are. And you know what I like about what Darwin is going to share with you is he's spot on in terms of where the opportunities are in the current environment with high interest rates, high inflation. And the great news is there are still great opportunities in the real estate space, and you really have to have the depth of experience and wisdom that Darwin has to find those. And I'm excited that we can bring those opportunities to you even in this environment today.
Well, thank you. I love having you on board.
Great.
Appreciate it. Thank you, sir. They say so many nice things, and I didn't even pay them, I guess, yet. Okay, so I know that's coming. Here is an idea of the start of our investment strategy. There's higher risk and lower risk. You can see opportunistic, value add, core plus, and core properties. A core property is downtown, high rise, class A++. Core plus, uptown, start getting into some suburbs. Value add, which is the thing that we love the most, adding value to that, and opportunistic. And this box shows where our target is. That's the area that we want to go ahead and look at. We'll dip into the highly opportunistic, but staying out of bad areas and staying out of high risk. And the ironic part about this whole chart is they're saying lower risk are core properties. And I actually disagree with that. And the reason I disagree with that is those core properties are class A, A++, downtown, fully occupied, high rents. The only way they have to go is down unless the market is just going up. If the market's going up, everything is going to go up. So I'd rather not take the risk on those core properties. We do have some class A type properties with the mark that we're buying, with Frankfurt. I would even say, Oakview and Gold Creek, I'd still call those B properties, garden style suburb, but those are our target is the value add. A true value add is hard to find. I've been saying this for about 4 years, but you can still add value in numerous other ways. Will Rogers, I'm not so much interested in the return on my money as the return of my money. Who agrees with that? Yeah, and luckily we can get both, but this is kind of a theme. If I were to say what the theme of this presentation is fear, okay? Has anybody had any fear over the last 9 months? Anybody afraid of the economy? What's going on? Okay, I can see that with supply chain, with inflation, with higher interest rates, everything else. Okay, but there's always opportunity in those situations. And it's funny, I was looking at our 30-year investment strategy, and it has evolved over the years. There's some of this that has taken some additional steps, and I thought, how do we want to change our investment strategy going forward? And I started thinking about that, and I said, I don't want to change anything. It's still a sound business model. It's still always sound. Lock in long-term fixed rate debt, okay? We get 10-year loans. I like those loans because it allows you to ride out any of the waves. Now, the last 5, 6, 7 years, everybody, let me rephrase, most people switched to the variable rate loans, the adjustables, right? I mean, you saw it. As far as everybody's go to those adjustable, because with rates going down, if you're locked into we had one property, Brookside, we were thrilled. We were at a 4.85% interest rate when we bought the property. Sub 5, we're thrilled. But what happened to rates? They went down and down and down and down. Was anybody invested in Brookside? Did you like how that investment turned out? Okay, what was the overall return on that? Any idea? 15.8%. Average annual return, 15.8. We had a $22 million loan. Did you know what our defeasance was?
Don't tell us, please. Don't tell us.
Okay. It sucks. About $5 million in prepayment penalties. Okay. Anybody else looking at that would go, holy crap, you gave up $5 million. Well, the reason that we had that appreciation like that in the first place is because interest rates went down. It increased the value of the property. But I would rather lock in and minimize our risk rather than maximize profit. Because if we did that same deal, let's just say 2 years ago, where are people who bought in the last 2 years with their adjustables? Anybody experience any problems with the adjustable rate loans with any of the other sponsors or anybody else? Really? 2?
Those are the people that are willing to admit it.
Okay. Okay. Yeah, it's everybody. Yeah. And so in my investment philosophy on locking in that long-term interest rate, it hurt us in some areas. $5 million on Brookside that the bondholders got that we didn't, but we still had a great return. But if interest rates would have went up at any of those times, we would have been protected because we have an assumable loan that somebody else can assume. That'll help if interest rates go up, the values go down, and there's an assumable loan that gives you some protection or hedge against that lowering property value, okay? Of course, the cons, defeasance, and FOMO. Who knows what FOMO is? Fear of missing out. Again, everybody's looking at that going, oh, you lost $5 million because of that loan. No, we made $7 million on the deal. Increased cash reserves. Okay, we put in there a lot of cash reserves just in case of any problems like that. Between that and fully funding our CapEx, the biggest problem with that is it increases our capital requirement, which lowers our overall projected yield. But that also protects us from any downside. We've got enough cash in the bank in case there's a problem. We're fully funded on our CapEx. So many sponsors out there say, I'm only going to raise enough money to do 10% of the units, raise those rents, and then I'm going to flip it and sell it. Say, see, look, I could raise the rents. This is the proof of concept and sell it to the next guy. A hot potato scenario. We're not flippers. We look at longer term holds. You know, we project 5 years. They've been anywhere between 3 years, sometimes even shorter, and as many as 7. But again, we want to be able to ride through those with our long-term debt. Again, it makes it harder to have anything make sense. Julian, he analyzes so many properties. Doesn't make sense, doesn't make sense, doesn't make sense. If there's something close, take a look at this, see if it's close. But we're going to keep our strategy the same. We're still looking for those value add projects where possible, good locations, good demographics. And the way that we underwrite, people say, what is your cap rate you're looking at? I don't know. I don't even look at the cap rate. Is it tax adjusted, insurance adjusted now, et cetera, et cetera, et cetera? I don't care. I look and see, can the partners make a 16% projected average annual return? That's our target. Are you happy with 16? Yeah, especially now. So that's our investment strategy, and we're not changing that. We're not backing off of that box we buy in, and we're still looking for those opportunities. And it is absolutely encouraging that we have professionals like Charlie that's been doing this for a long time saying, hey, your strategy is solid. And it's proven itself through this through this cycle. 2022, here's how most of the cycles work. And you've heard the saying, bears take the stairs, bulls take the window. Okay? That's exactly what it is. Growth, 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 crash. Okay? I think we're about here right now. Okay? And the reason that this is tilted sideways, obviously I had to tilt it sideways myself, because this is a good idea of 4 to 5% growth. Okay? So even though it dips down, when it comes back out, it's going to be higher than when it went in anyway. Okay? I heard an interesting statistic. 1927 Great Depression, stocks went down 90%. They had to go up over 900% just to come back to even. Okay? In 2008 to 10, the crash on real estate, prices went down nationally 22%. However, those had recovered within 3 years. So would you rather be in the stock market during a crash or in real estate during a crash? Okay? So that's why we say now is the time to start looking and buying. Commercial interest rates, they doubled 3.25% last January to 6.5% now. Unprecedented. Unprecedented. Here's what's funny. The 30-year average is 5.25%. Looking back 30 years. So we're still not doing that bad, even at 6.5%. And that's coming down. For example, our quote on the mark is 5.4% right now. Fixed 10 years, interest only for 10 years. Agency debt. Okay? Now, why did those interest rates go up? The short answer is fear. Okay? So, inflation, because of COVID and stimulus, the government pumping in so much money into it. Of course, supply chain, all the other problems that happened in the last year. And the whole idea is the Fed wants to raise rates. This is kind of a grudge match, it seems like, between the government and the Fed. Government prints a bunch of money. Now the Fed has to raise interest rates to combat the inflation that it creates. Yet they just passed another, 1.7 trillion? Is that what they just passed? So more money coming into it. So they're going to want to try and still force that until Fed says they want to raise rates until what? Till what happens? Until they don't print the money. What else? Inflation comes down. Okay. How do they say inflation comes down? How? Reduced job growth. They want higher unemployment. Okay. Amazon is laying off 18,000 people. Goldman Sachs laying off 12,000 people. Those are just two right off the top of my head. So I think they're going to start to see layoffs coming. And my prediction, which by the way, I don't know anything, it's a wild ass guess, is that the next meeting is February 1st. I think they're still going to be bumping up again. I just don't think they're going to be as aggressive as they have been. And that'll happen for a couple more months, would be my wild ass guess. And again, complete guess. But then it'll level off and stay leveled off. That forward-looking curve where they base interest rate cap insurance, that will start to come off a little bit, so it won't be quite as scary. But the big thing is that fear in the market. Two things. Treasuries, which is what most of our loans are based off of, the 10-year treasury. There's an inverted yield curve. Anybody know what that is? Okay. The 10-year treasury, I don't remember the numbers off the top of my head. Let's just say the 10-year treasury is at 3.5. Okay. The 2-year Treasury is at 4.5. Now, why would you lock up your money longer for a lower interest rate? There's not a good reason to. They're only trying to lock it up in a short term because the general populace thinks that, hey, after that time frame, it's going to come back down and then we'll be in a good position. So the treasuries get pushed up by the market on what their fear is and what they think that is. It's not the Fed or anything else. And then the agencies, they take that treasury and then they put a spread on that. Do you know what the spread was last January, Julian? It's about a point. So treasuries were at, 0.5%. And then they had 1.5 interest spread, just picking numbers out randomly out of the air. And those two combined come up with your rate that you pay. Well, the agencies are afraid also, so they increase their spread. So not only did the index go up, the spread went up, which is causing higher interest rates. So that should start to come down. Current problems, large bid to ask delta. You've got sellers that still want to sell at a 4 cap or lower, and buyers who are saying, wait a minute, our interest rates are over 5%. Why would we pay for buy a property with a 4% yield when we have to pay 5% or more? Make sense? Well, it doesn't make sense, but you understand what I mean? Again, and individual investors, those of you in here, rightfully so, you're afraid. What's going to happen with the market? Do I need to hold on to my cash? Well, if you hold on to your cash, it goes down by almost 10%, right? So you got to do something with it. You have to invest somewhere. And how many of you are in other deals, other sponsors? Not anymore. Any cash calls? Not yet. Have you heard of anybody getting cash calls? No. Okay. I know quite a few that have had cash calls. Quite a few people are having cash calls. What about cutting back or getting rid of distributions? Yeah, all over the place. Everyone. They're all cutting back on that because they didn't have enough cash reserves. They're not in a good place, et cetera. And if you have an adjustable rate loan, that's one thing. Another problem is there's one guy that I know. He was escrowing $2,000 a month to pay for, okay, who is not familiar with interest rate caps? Okay, everybody's lying. Okay. See, somebody brave, thank you so much. Interest rate caps, basically when you have an adjustable rate mortgage, the lender says, hey, wait a minute, if interest rates go up, you can't afford to pay this loan, so you have to get insurance. So if it goes up above that amount, then the insurance pays the difference. Okay, so that's an insurance policy. And just like your homeowner's insurance, you've got your amount that you pay, and then the lender calculates how much you're going to have to pay next year, and they escrow for that each month, right? Follow? Same thing with insurance rate cap, is they price out what they think it's going to be next year, and they start escrowing that payment. I know one guy, his escrow payment was $2,000 a month, okay? That he had to escrow to replace that insurance policy when it came due. That $2,000 a month is now $100,000 a month. Okay? There's another risk of adjustable rate loans. Okay? So that is completely killing cash flow. Could kill the property. Okay? All because of an insurance policy. Okay? Sponsors. Last 12 years, not many sponsors have seen a down market. They don't know what to do to go through it. Everything's been rosy. Everybody's a hero. Everybody's made money in real estate the last 12 years. They're less conservative. They're a little more aggressive. That's how they've been taught. Is you be aggressive, you go ahead and do it this way. Newer sponsors having problems, and they've got no depth in their bench. It's one of the things that some people, when you're investing in a sponsor, you're investing in that team. And we've got Julian and Brian and Vicky and Brian Johnson and now Ben and now Charlie and all these other people involved. So we've got a deep bench that can actually advise and say, and they're not afraid to say, Darwin, you're wrong, and kick me in the head. Okay, so that's very important that we have this think tank of everybody behind us. And a lot of people don't. Einstein, in the middle of every difficult lies opportunity. Okay? We're having difficulty, we're having fear, so there's an opportunity here now. Warren Buffett, you want to take advice from the best investor in the world? Okay? Be fearful when others are greedy, and greedy when others are fearful. Okay? Everybody's fearful right now. So what's the time to do when you're afraid? Be greedy. Okay? It means invest, get it out there. Like I said, the theme of this is fear and overcoming it, and why you shouldn't. Why you shouldn't be afraid. Blood in the water, bridge debt. This bubble I call a bridge debt bubble. Okay? Agencies basically weren't getting any action. And so there was a vacuum filled by that, by bridge lenders who were loaning on future value of the property. Well, those bridge loans are gone. You can still get bridge loans from banks, but they're over 7%. Okay? That hurts. That makes it even worse. Rising interest rates, killing cash flow, interest rate insurance, all of those things that we just talked about. And a big thing is the values are down between 10 and 30%. Okay? That's why you have to have the cash reserves and the debt to ride through any of these problems. Otherwise, you're forced to sell in a down market. So I think there's going to be blood in the water with people that are in those positions that they have to sell. Okay? So that's why we're talking about maybe a rescue fund opportunity, where we start a rescue fund to go ahead and take advantage of some of those. Might be opportunistic, or you can call it a rescue fund. 2023. The great thing about this, fewer buyers. Okay? Fewer buyers makes more opportunities available for us. Real estate's on sale. The biggest problem, though, is the amount of debt you can get is much lower. Okay? That's going to require a lot more capital to buy a property. For example, agency loans are between 50 and 63% loan to cost to get an agency loan. That's a whole lot more money out of pocket. The other thing is it's going to weed out the weak or the unqualified. But the big part is fear is keeping people like you that are going to keep you out of the market. Okay? So that's where we're saying is you still have to put your money somewhere, otherwise it's going to lose value. I had somebody talk about sales one time, one of those sales seminars, and I don't like high pressure sales. I don't like that. I basically say, here's the information. If you like it, great, we'd love to have you. And somebody said, look, you have to look at that as you're providing a service, a product or a service to help somebody. Here's the whole thing. If you're not investing, if you put your money in the mattress, you're going to lose 10%. Okay? If you don't invest, okay, and this is me speaking, okay? If you don't invest with me, then you're going to go somewhere else and maybe hook up with some of these other sponsors or look at other opportunities with other people that are given the high pressure sales pitch, and you think, the timeshare sales, you've been through those, you're an idiot if you don't buy, basically. Okay, and I love going to those just to see what they're doing. But again, they're not looking out for your best interest. I'm saying here, we are doing this. We may not move as fast. We may not have as many deals, but we are damn sure going to protect your capital. Okay? So we need to keep you off the sidelines, get you into the game, and still make sure that we protect your capital. Here's an interesting chart. Okay? The bubble in 2001, the tech bubble, when things went down. The big real estate bubble, everybody saw that. Okay, then it went down, then it went back up, and now we're in what like I said, the bridge loan bubble, and now that's coming down. Excuse my poor drawing. It's really hard to draw on an iPad, so or even write bubble. Here's the question. Without looking at the chart, okay, look at me. What year would you want to go back and say, I should put everything I have and buy real estate? What year would that be? 2011, 2012, 2013, that area in there. Now, why? 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 It was down. It was down. Okay? That's when it goes on sale. That's when the opportunity is. Think people were scared there? Think people lost money right before that and said, I am never buying real estate again? We started buying in 1989 after the 86 crash. In Texas, We could buy in here so cheap because everybody in Texas said, I am never buying in Texas again, ever. Okay? Because some people say a V-shaped recovery. Some say a teacup. Some say a bowl. The problem is, in Texas, it was a platter. It went down and stayed down for a very long time. Okay? Well, that's where people are fearful. Go back and think about that. Where were you in 2011? Did you put money in 2011? Or were you still scared? Do you want to buy here? No. And you can't time the market is the biggest problem. But when you're down here, that's when you want to buy. And that's what's happening with this bubble. This is taking us down. This solid axis line here is about a 4 to 5% increase per year in value. Okay, just like that other one that I told you about the recession. That's the same type of thing. I went above, and even when it dropped back, when this went down, when it came back up, it's still back up in the market. There's still an increase in it overall. So that's the same thing that's happening here. So you've got this bubble. It's now going down. It's going below that axis. You go below that axis, that's the time to really, really double down and buy. Okay? Here's the question. Anybody take any stock trading classes? Anybody? One. Long time ago. I remember one class that I took, and this was like 30 years ago. So you buy our program. If it gives you 2 thumbs up, then you buy. If it's only 1 thumbs up, you don't. If you do that, then it's a sell. You remember that? No? Okay. That's the same type of thing here. It drops below that line, buy. But what's everybody doing? Oh no, the market's bad. I'm scared. I can't. Okay? Think back to 2011. Now, I'm not saying we're in 2011. I want to make sure that that's clear. It could go down a little bit more. It could keep on going down. But you lock in long-term debt. You'd be able to ride through that. And as long as you're not spending money that you need to live off of, yes, keep some money in reserves. Yes, diversify. But you definitely have to make sure you stay in real estate, because do you want to buy here? Do you want to buy here? Okay. We still did good all these years. Okay. But you have to go ahead and look at that, how you ride it out. Those 10-year loans, look anywhere on this chart. Go to the very far, 2006, or yeah, about 2006. Well, 2016, we had 10-year debt, okay? That was over here, so it's still up. So that's why we get long-term fixed rate agency debt, is it protects us in the long term that if there is a dip, we can ride through that, okay? My dad used to call the short-term loans neutron loans. Anybody know what a neutron bomb is? Kills all the people and leaves the buildings, okay? So you don't want a neutron bomb. You don't want a short-term loan. Now, have we taken them? Yes. Have we had bridge loans? Yes. Do we have some properties that are going to take a little bit longer because of our CapEx plan, that being Lakeside, Bent Creek, and Amber Trails? Okay. Those three, yes, it's going to take a little bit longer for us to do distributions. But all the other properties we've been doing distributions on, they're just chugging along. You're still getting your checks? Who's still getting their checks? Okay, good. ACH transactions. Sorry, still getting your money. Let's put it that way. Forget about checks. We're not doing that anyway. Again, I want to pause on this again. Where do you want to invest? When do you want to invest, I should say? What time frame? I mean, in retrospect, we go back to 2011, right? That would have been the best. That was great. It's when we did Valencia. 175% in 2 years.
Yeah, I was in that deal.
Yep. So again, the market's down. Don't be afraid, okay? We still put in a place of being conservative. We still have to ride through everything. And now is actually the time to invest, okay? When it's down, it's on sale, okay? Any questions on this? Any questions, comments, thoughts, ideas? Okay, so why is that bridge loan bubble, why is it there, and why is it toxic, and why is it a problem? Bottom line is the market was so frothy. You remember 2 or 3 years ago, right? Everything, buy real estate, buy real estate, buy real. What's that old saying? The stockbroker that got into the taxi and taxi driver said, hey, you want a good stock tip? You know, buy XYZ. And the guy in the back called his broker and said, sell everything in XYZ. Because if the taxi drivers are saying invest in it, it's too late. You know, it's time to get out. Well, that's how it was a few years ago. Everybody you know, everybody, got to get in real estate, got to get in real estate, because they're going to fear of missing out. But that frothiness, the lenders, the professionals basically were, and even us, we backed off, became a little bit tighter, didn't buy quite as much. That's why we were a net seller last year. And that got backfilled by those bridge lenders who were just trying to be opportunistic and take advantage of the situation by providing funds at, and again, they were still low rates, they were still good loans if the market wouldn't have crashed. But the problem is they just fueled this beast, which pushed the prices up higher, and now that's got to correct. If there weren't things like these market fluctuations, real estate would just go straight on up, nice and simple and easy. But it's all of these emotions that come into the market as, hey, I got to put money in, I got to do something like that. Either that or, hey, there's all this stimulus money. When it's free money, you invest like crazy. And that's what happens with those low interest rates. That's what pushed everything up. And this bubble now has burst. It wasn't very big, but it's still there. Okay? I don't know how to beat this into your head at all. But when it's on sale, when the bubble bursts, that's the time to do it. It's not the time to be afraid. It's the time to go ahead and invest. Okay? Why DFW? Year over year, still 12.3. I was just talking with Brian earlier. On our portfolio, rents are still up 10 to 12% over last year. Okay? DFW is a great market. Yardy's predicting over 11% rent growth next year. Now, in DFW. Okay? Other markets, they're already hit too hard. The increasing cost of capital is driving the prices down, driving the cap rates up and the prices down. Okay? And then we also, of course, the higher interest rates. Anybody tried to buy a home in the last 6 months? Okay, interest rates, nuts. Okay? You know, and we all look at that and go, I refinanced at 2.9%. Okay, you can never sell, right? Okay, so there's going to be fewer people selling their houses. They can't. They got such great loans on them. The higher interest rates, people aren't qualified as easy because you have to make 3 times the amount of the, well, you have to make about 3 times the amount of the loan, but that's now going up. You have to make 4 times because the interest rates are higher, or whatever the equation is on that. But bottom line is fewer people can afford a house. They have to have more money down. Even on commercial properties, you have to have more money out of pocket. It's going to take more money to do everything. And in a time when, who's been crunched on their personal finance, you don't have to answer that. But I mean, it's getting harder to make a loan payment, to make a car payment, to buy groceries, to pay for gas. At least gas is coming down some. That's all good. So many things happen to pile up to create this crash. I was looking at, was it last year and a half? A container ship from China, which was $2,000 to get over, went to almost $20,000 to ship over. Okay, there's higher cost of everything from China. That's now back down at like $1,400. Okay, so that's coming down. Everything's going to start coming down as far as inflation, which will have the feds backing off. So right now is a short time window to go ahead and invest. In Texas, we still have relocations coming in. We still have growth. You look at the population growth. If there's jobs coming in, then there's more people moving in. For every white collar person, there's 3 blue collar jobs that come in. So that will keep spawning our growth, which is why DFW in Texas is so strong. Okay. Now, how many of you have not heard about Iron Ranch? Okay. Iron Ranch, we're going into a little bit different direction. We're going to build this, it's called Office Flex. Okay. This is flexible. It looks like retail. It could be office. It could be like urban garages or garages of Texas, which is why we have cars in this particular one. We're building our first deal in Fate, and we're going to be building them hopefully all over the country over the next few years. This particular deal, I did the worst deal for me I've ever done, but the best deal for the investors. Because it's a proof of concept, we offered a 25% per year pref. Okay? You have never seen that. You will never see it again as far as that amount of preferred return. And this is all because of proof of concept, and it's such a lucrative deal. But we're going to be building these all over town. I think this one's full, but we're getting started on that very soon. We did value engineering today on, basically value engineering is the designer says, hey, let's build this. It's all pretty. Then you go give it to the contractor and says, oh, it's going to cost this amount. And you're going, no. Okay, so we've got to look at that, see where we can cut back on our design to go ahead and save money, some of that value engineering. The next one that we're starting to raise money for right now is the Mark. Has anybody heard about this one? Okay, the Mark. This is a cool story. This is the Mark at Weatherford. This is a builder that supposedly, purportedly, builds for themselves for long-term holds. Now, I've seen the Mark around. You'll start to see it now. If you look up and down the freeway, I was driving down Central the other day, and there's a big, that same property called the Mark right there on Central Expressway. And they build these, and they're developers. Last January, they got offered $315,000 a unit for this property. And they said, no, we're not going to sell. You know what? We hold long term. Well, then all of the debt crunch came, and they said, we've got these other properties we're building, so we better sell a couple of our properties to go ahead and free up some cash. So they put this on the market. Thankfully, they are professionals that are not, emotionally attached to their investments. By the way, that's one of the big rules on real estate and investing. Don't be emotionally attached to it. And the broker said, if you want to sell this, it'll be about $215 a door to sell it now. We've got it under contract at $215,000 a unit when they were offered $315 last January. So it's on sale. Replacement cost is probably $240,000 a unit. That sound like a good deal? Okay. This is roughly $78 million. It's in Weatherford, right across the street from Weatherford College, right in the heart of everything going on in Weatherford. 4-story, beautiful, 10-foot ceilings, granite countertops, stainless steel appliances. It's actually prettier than Frankfurt. Okay, it's a better. You walk into the office, grand 2-story, beautiful office. They've got a 2-story fitness center, a resort-style pool. That a lot of people say resort-style pools. This one actually is, and it's more of a party pool. It's only 3.5 feet deep. So you're not talking about drowning or diving or anything like that. But they got, I like on the resort style, they've got these little cutouts with seating everywhere so you can have a lot of people out there. My wife wants to go to Crash My Playa, and that's kind of what I see on this is, you know, that thing down there, you know, everybody in the pool. It's got a business center. It's got conference rooms you can rent. And one of the things that I like about it, they also put in a water well to feed their pond, which provides irrigation that they just finished. That'll save $20,000 a year on irrigation expense from water and sewer. So they've done a whole lot. It's a beautiful, gorgeous property, probably one of the nicest ones you'll invest in. And this is one that we're rolling out now. Right around that area, yeah, they're very expensive homes. $350,000 to $500,000 homes right there, $5 million in that immediate area. Okay, so this is right in the heart of Weatherford. So we've got, is the video up on, has that been sent out? Oh, okay.
Darwin German Real Estate is pleased to present our next investment offering, the Mark Weatherford. The Mark introduces investors with a great opportunity to capture a yield play property in Weatherford, Texas. Constructed in 2021, the Mark is comprised of 355, 1, 2 and 3 bedroom units. Weatherford is served by major highways including Interstate 20 and Highway 171, making for convenient commuting for the Mark's residents. The Mark is in close proximity to shopping, dining and entertainment centers, along with Weatherford College, which is across the street from the property. Adjacent neighborhoods to the property offer homes that range in value from $350,000 to $2.5 million. Unit amenities at the Mark include faux wood flooring, two-tone paint, walk-in closets, built-in microwaves, as well as full-size washer and dryer hookups. The property also has a shimmering resort-style swimming pool, multiple barbecue grilling stations, dog parks, a practice miniature golf green, business center, two-story gym with commercial quality equipment, and much more. The Dallas-Fort Worth area remains in the #1 position in terms of apartment absorption and demand. After taking a pause in 2020, demand came roaring back in 2021 and 2022, ranking DFW at the top for apartment demand in the country. Since 2010, the North Texas occupied apartment count has climbed by a stunning 201,000 units. During the last 11 years, the Dallas-Fort Worth area has absorbed the equivalent of every single apartment unit in a metro the size of Charlotte, San Antonio, or Las Vegas. We are excited about adding the Mark to the DGRE portfolio and about making this investment opportunity available to our family of partners. Please reach out to the Darwin German real estate team if you would like additional information about this exciting opportunity.
Pretty property? It's gorgeous. It's unbelievable. Here's our projections as far as what, and again, you'll get more detail on all this. Year 1 and year 2, I put additional below the line expenses as additional cushion to manage expectations. We're saying the first 2 years, don't know what the market's going to do. The reason that I did not buy more right there is because I really wanted to make sure that we had cash flow going in. People that were much more aggressive than me came in there and said, look, I don't care if there's cash flow or not, this is going to go back up. Maybe they were better visionaries, maybe they were bolder, maybe they were dumber, I have no idea. But that's the reason why we didn't do as many deals there, is because I wanted to make sure that we had cash flow on it. Who was in Park Row? Okay. We paid $8 million for Park Row. The current investors that provided a lot of the capital paid $38 million. Okay. That was one that we bought back here in like 2010, $8 million, and now it's $38 million. So it didn't matter if there was cash flow to them, they were riding that market up. And that's the same thing that I want to make sure that we know, that right now on things like this, I'm taking out any projected cash flow to partners to put that in additional reserves just in case. Okay. We're looking at a 3-year cash out refi now. This does have about $10 million in private equity. Okay. And we'll talk about that more later. I don't want to go into a lot of details on this, but a big thing that I want to show you is, first off, 17% per year average annual return. Is that good? Is it a solid asset? Yes. You haven't seen it, but I'm going to tell you yes. Okay. Here's the big thing. We're going to be all in at $80 million, which is $227,000 per unit. How much were they offered back in January per unit? $315,000. What is my year 3 value that I'm projecting? $302,000 per unit. My projections are so conservative that in 5 years, we're not saying that it's going to be even back up to where it was in January. Okay? So I think we're very conservative on that. Imagine if this is $350,000 a unit in 5 years. How much higher that return will be. Again, we try and be very conservative on our underwriting so that we can outperform any numbers that we give. But $302,000 per unit for something they were offered $315,000 a year ago, I think is extremely conservative. Anybody else agree with that? Yes. Again, this is the reason why I think this is very exciting. We're doing things with Ben. Ben's going to be bringing in family and friends and hopefully some high-profile individuals to invest. We're actually starting a fund. We're actually starting 2 funds through his contacts, 2 $100 million funds to invest in property. One is going to be just as Class A shares, just like you invest in now. And the other one's going to be a private equity fund for people that are doing IRA. It's fixed. It's a fixed return. It does go ahead of common equity, and they don't get the tax benefits. But we want to open that up as an opportunity for people that, hey, look, I'm still afraid. I don't want to be in these properties. Well, this is a fixed return investment that some people will want to be on depending on where they are. Because we want to make sure that no funds left is something that they don't have happen to them. What percentage did they say go broke? When you join the NFL, they put you through, I don't know if it's a financial boot camp or whatever it is, and saying, hey, you guys are all getting paid a lot of money. We want to warn you. And they say 85% of you will be broke within 3 years of getting out of the NFL. What do you think all of them say? Not me. Not me. Yet statistically, it's 85%. So that's why we want to make sure to give some opportunities to them to preserve that capital long term, because it's more important that I get return of my capital than a return on my capital. But we want to provide both and do that long term. So with Ben Garland coming in and doing that, with Charlie coming in and helping on all this, and a great advisor, tax-wise, structure-wise, contact-wise. These are two very big power hitters that I am humbled that they are coming on with me. I told them today, we had lunch today, and I said, I feel like I'm on the junior high football team, and they just put me in the NFL. And they say, you're selling yourself short. So bottom line is, don't be afraid. Now is the time to take advantage of opportunities. Listen to Warren Buffett. Be greedy when others are fearful. Everybody is fearful. They don't know what's going to go on the market. None of us do. The market could go down. It could crash completely. But I know that if I were in the stock market, it goes down. I don't even have a piece of paper to show for it. I have a blip on a screen that showed what I was worth and what I am worth now. What I love about real estate is it's still there. There's still an asset there that we have control over, that we can do something with. We have a lender that's behind us that they're not going to want to say, hey, we want the property back. They want to know that we're doing something with it. We can make an impact. And with the deep bench that we have with all of our team, then we can make things work. So again, don't have any fear in the marketplace. Take advantage of these opportunities and buy in the dip. And that's where we are right now. We stay conservative. We stay transparent. We're still going to tell you everything that's going on. Ben and Charlie being here is a huge, I don't want to say endorsement, but a huge, what's the right word? A huge asset to us, but it definitely gives us reinforcement that we're doing the right thing. What was the word? Credibility. Another great word. And so I am very honored and humbled that they are coming on and helping us with this. And because all this is for you, because what is the motto, Brian?
Always do what's right for the partner.
Always do what's right for the partner. So we're doing what we can to protect you, to make sure you're protected and that your assets grow. Again, thank you so much.